Good morning, everyone. Good morning, Nidhi. Good morning, Uma. Good morning, Sriram. Good morning, everyone. So yesterday, I hope those of you who had to leave in between, in case you left, you could go through the session on 113. Good morning, Viraj. So I hope that it was fairly clear and you still have the weekend to go through all the questions, the examples which I told you to go through. As far as the topic, the theory is concerned, please let me know if you have any doubts. Okay. Maybe we'll try to see if I can address them on Monday in our class on Monday. Okay. All right. So today we commence a new standard, that is Ind AS 102, that deals with share-based payments. Good morning, Vidit. Good morning, Anita. Yeah, so share-based payment, this is a very, very important standard from your exam perspective, because in almost every attempt, every RTP, you have a 8-mark question that comes from this chapter. Okay, so it is an examiner's favorite and it is very, very scoring for us as students. So please ensure that between 113 and 102, I would place 102 at a very high pedestal in terms of importance from examination perspective. Okay, so we start this standard today. Good morning, Panu. Good morning, Asha. Okay, so share-based payment, we had a guidance note in case you, okay, so before I start, I have uploaded the content. I hope you have received it. Okay, I'm not sure. I did not see the app or the website, but I had uploaded. So you should be having this presentation of mine, which contains a very detailed presentation of the standard, and it also contains in the assignment section the problems that we will be doing. Okay, so these are the two things that I have uploaded. Please confirm if you have them available. Okay, all right. So good morning, Namrata. So if you remember, in your intermediate you would have studied a guidance note. You would have studied a guidance note that dealt with employees' share-based payments. Okay, so this was the only document that was available for discussion under the IGAP regime. We did not have a standard that dealt with share-based payments. However, when we transitioned to Ind AS, IFRS had a standard that dealt with share-based payments, that is IFRS 2. So now for us that has become Ind AS 102. Okay, all right. Okay, if it's not available, maybe it will be available by the end of today's class. Okay, so I'll ensure that it comes to you today. Okay, it will be there because I already uploaded last night. So it will be there. Okay, so now coming to the difference between the guidance note that we had and the Ind AS 102 standard that we have. The guidance note was very limited in its scope, in the sense it covered only employees' share-based payments, whereas Ind AS 102 is very wide. It does not have the word employee included anywhere. It has just share-based payments. So any payments made to the vendors in the form of shares or in the form of a consideration dependent upon the share prices, these become my share-based payments. Okay, so it could be paid to employees, it could be paid to vendors, it could be paid for acquisition of fixed assets. Anything that is done in the manner that requires issue of equity instruments or payment of cash based on share prices, any of these things that happen, it gives rise to a share-based payment transaction, which will be applicable, which will be covered under Ind AS 102. So the scope is very wide. Now, why did we have a separate standard on share-based payments? Well, we are coming slowly into a startup culture. It's not slow actually, it's pretty rapid right now. So we are into a startup culture where you have payments that are made in the form of stock options to employees, and so these are the kind of things which we start to see now. There are new ways employees are remunerated, so therefore we needed a strong guidance in this regard, and that is why you have a dedicated standard on share-based payment. Okay. So what will be my approach is I will introduce you to some of the basic concepts. Okay. Some of the basic concepts, then we will discuss and build up on these concepts with the problems. Now there are huge number of problems. Okay. This sheet, I think it's a 22-page sheet that I have shared with you. Huge number of problems. So what I propose is I will give you one or two standard formats, okay, when we solve, and then I will run you through the problems as well as the solutions. Okay, so in that way, what will happen? I had not shared this sheet earlier with the students because I used to sit solving the questions. But what I thought was, if I put this sheet across to you guys, then you will be in a position to solve. We can be in a position to solve a lot of questions and understand the concepts therein. But the calculation part, why I used to solve is so that students get a flair of actually calculating in the session. Now, if I share this and discuss through this, the calculation part will be a little quick. That means I will run through the solutions. You will have to sit and do the calculations in the back end by yourself. Okay. You'll have to physically sit and solve. But the advantage of that is I get to cover more concepts in the short time that we have, that is today and Monday. And at the same time, you also get the benefit of understanding the concepts, having a better discussion on the concepts rather than, writing each and every question. So I thought that we'll change the methodology a little bit this time. I hope that it suits you. Okay. So now, let us start with the standard. Again, as usual, my presentations are standardized. So we will always start with why there is a need for Ind AS 102. Then we have certain defined terms which I will take you through. Then the scope as well as the recognition as per Ind AS 102. The major portion of this standard deals with equity settled, deals with share-based payment transactions pertaining to employees. So though it is an SBP, the crux, you can say about 85 to 90% of this chapter is focusing on employees' share-based payments. Because the other part, that is non-employees payments, those are very simple to account. So that is why most of the problems you will find this. Okay. Then you have equity settled share-based payments. You will have cash settled share-based payments, which we popularly used to know as stock appreciation rights, SARs. Then you have share-based payments with cash alternatives, and you have share-based payments among group entities. So most of it you know, but some of it you do not know. So that we will be going through. Okay. So with this, let us start our discussion. Okay. So why do you need Ind AS 102? Okay, so the objective of this standard is to specify the reporting for an entity undertaking a share-based payment transaction. So this is the major objective. Okay, undertaking a share-based payment. So the moot question arises, what is a share-based payment transaction? So this is nothing but a payment based on the price or value of shares. See, it is nowhere saying that it is equity shares. Is it limiting it to equity shares? Answer is no. It is saying any payment which is based on the price or value of shares. So it could be equity, it could be cash, it could be an option that is there with the holder of the instrument to exercise equity or cash option, whatever it is. But the important point is the price or the value is based on the price or value of the shares of the entity. That is why we call it as share-based payments. Okay. So examples could be employee stock options or payments to suppliers of goods or services. So we have a share-based payment standard, whereas earlier what we had was a guidance note on accounting for share-based payments. Okay. So I discussed this in detail. All right. Now, what is a share-based payment transaction? Okay, what is an SBPT? An entity receives goods or services from the supplier of those goods or services in a share-based payment arrangement. Okay, so entity receives goods or services from the supplier in a share-based payment arrangement, or it could be an entity incurring an obligation to settle the transaction with the supplier when another group entity receives those goods or services. Okay, so this part is new for us. This is not there under the what you can say, under the guidance note, whereas this part, as far as it is restricted to employees, it was there under the guidance note. Okay, so for example, A Limited issues stock options to its employees, or it issues shares to a supplier of property, plant and equipment. So when this is the case, what happens is, A Limited issuing stocks is a share-based payment transaction. Shares to a supplier of PPE is a share-based transaction. Okay, so I have certain questions flowing in. Shriram sir, does it include preference shares also? See, it depends on how am I classifying my preference shares. If I go by the financial instruments definition and my preference shares meet the definition of equity instruments, then very well, yes, it will include my preference shares as well. But as we all know, as far as the Indian regulations are concerned, preference shares are typically going to be classified as liability because they are, what you can say, compulsorily redeemable preference shares with a maximum maturity of 20 years, I think, under the Companies Act. So therefore, they become my liability instruments. Okay, they become my liability instruments. But if your instruments meet the categorization of equity, then yes, it will be a share-based payment transaction. I have another question from Vivek. Sir, will cash be a part of SBPT, and why would it be so? Okay, see, suppose I give you two options. Okay, let me just explain this. I give you two cases. Okay, suppose you are an employee with a company like MRF. Okay, you are an employee with a company MRF. Okay, if you recollect, or if you probably follow the markets, the price of MRF's shares is in the range of 80 to 85,000 per share. Okay, it is in the range of 80 to 85,000 per share. Now you are an employee with MRF. There are two schemes which go to you. Okay, the first one is, I will issue an ESOP, that is an employee stock option plan. Under the stock option plan, you have the option to purchase this share of MRF, to acquire shares of MRF after some years. Okay, we'll come to all those conditions, vesting conditions, service performance, whatever it is, we'll come to that later. But under the ESOP, you have the option to exercise the option. That means you have the option to acquire the shares for rupees 60,000. Remember, the market price is 85,000. You have the option to acquire at rupees 60,000. So this is the first thing that you are having. Okay, the first plan. The second plan is a stock appreciation right. The second plan is a stock appreciation right, wherein there is a price which is fixed. And any movement in the share value, thereafter, you will be paid cash. Depending on the movement of such share values. Okay, so now coming to the coming to the question. So here Here also we keep it simple. I'm just keeping it comparable. I'm not going into the nitty-gritties. Exercise price is 60,000, but you do not have to pay 60. Instead, what the company will do is it will give you the difference between current market price minus exercise price. So that means if I exercise it right now, 85 minus 60, this gives you 25,000 to employee. Okay. So this is how it works. Now, tell me one thing. What would you prefer? Would you prefer to go ahead for the ESOP, or would you go and prefer the stock appreciation right? ESOP requires that you should have 60,000 in your pocket. So you go to MRF, you will first pay 60,000. You will get a share whose market price is worth 85,000. That if you want, you can keep. Nobody is stopping you. But if you want, you can sell it in the market, get 85,000. Your net gain is 25,000. The important point to remember is, in order to gain 25,000, you must first have 60,000 in your pocket. That is the problem that ESOP has. You need to have the cash first to pay the exercise price. Whereas in the case of stock appreciation rights, MRF is not going to issue the shares. Instead, MRF is going to make the payment in accordance with the price movement of the share. So MRF will issue cash to the employee. It will make the cash payment to the employee of rupees 25,000. As far as employee is concerned, his position under ESOP and SAR is totally same. In ESOP also he's left with 25,000. In SAR also he's left with 25,000. But you are having a requirement to maintain cash reserves of 60 in order to gain 25. Whereas under a SAR, that is a stock appreciation right, there is no requirement. You will directly get the payment in cash depending on the difference between the market price and the exercise price. Suppose this goes to 90,000. Then what will be the payment made? Payment made will be 30,000 rupees. So cash payment is made, which is dependent on the pricing of the shares. And that is why we even include cash in these transactions. Okay. So this is the simple understanding that it includes cash as well. Okay. Is there any grounds of similarity between AS20 and Ind AS 102? AS20 deals with EPS, 102 deals, no, there is no similarity. For AS20, we have a corresponding standard Ind AS 33 that deals with earnings per share. Okay. And that is a fairly important standard by itself. Okay. So you are having Ind AS 33 for that. Okay. So SAR is also considered as a share-based payment transaction. Absolutely, Namrata. Absolutely. Okay. So this is the meaning of a share-based payment transaction. The other part of the definition, a new one, suppose H Limited issues stock options to employees of S Limited. You have a holding company, you have a subsidiary company. So the holding company issues stock options to employees of S. You can take it like this. You have Reliance Industries, you have Geo Platforms. Geo Platforms is currently unlisted. The employees of Geo Platforms provide services to Geo Platforms, and in return, Reliance Industries issues stock options to the employees of Geo Platforms. That is also considered under Ind AS 102. This was not there under IGAP. Okay. Or H Limited issues shares to S Limited supplier of property, plant and equipment. Geo Platforms acquires what you can say mobile towers or whatever you call technical equipment from a supplier. The payment of that supplier is made in the form of shares of Reliance Industries Limited, that is the parent. Even the other way around is going to work. That is, you have a holding company's employees and subsidiary shares are issued. For example, you have employees of Tata Sons and TCS issues its shares for the services rendered by employees of Tata Sons to services rendered by employees of Tata Sons to Tata Sons. So the subsidiary issues the shares. So even that is covered. How we'll do the accounting, that is a later part. We have a separate set of problems on that. But as of now, this is what you have to understand. It is a very wide standard that is there. Okay, so this is a share-based payment transaction. And in share-based payment transaction, we had something known as an SBPA. Both the legs you had this SBPA. Okay, so what is this SBPA? Share-based payment arrangement. It is an agreement between an entity and another party. Other party could be employee or supplier. So the standard typically words it as it is a transaction between an entity and a counterparty, or another group entity and the counterparty, or any shareholder of any group entity with the counterparty. Okay, so this on one leg you have an entity, or you have another group entity, or you have a shareholder of any group entity vis-a-vis another party which we call as the counterparty. Okay, by virtue of this agreement, provided certain conditions are met, the counterparty is entitled to receive equity instruments of the entity or another group entity. So I told you, employees of Geo Platforms can receive shares of Geo Platforms or can receive shares of another group entity, that is Reliance Industries Limited, or they are entitled to receive cash or other assets of the entity for amounts based on price. This is the core wordings of Ind AS 102. The payment that will go to the counterparty should be based on the price or value of equity instruments of the entity or another group entity. So it includes payments made in equity, or it includes payments made in cash or other assets. So when this is the transaction, this is known as a share-based payment arrangement. This is known as an SBPA, share-based payment arrangement. Okay. So you have certain what you can say examples which are there. These you will have to go through themselves because it contains, it's just, I'll just be reading it out, which is not required at this stage for you. Okay, you can go through it and understand by yourselves. Okay, so what you have to understand is there are two possibilities. Okay, suppose you are an employee of Reliance Industries Limited. Okay, so let us suppose that I'll take one of your examples only. Let us assume that Shriram, who is attending the class here, is an employee of Reliance Industries Limited. Okay, I hope you don't bother. Okay, it's just an example, don't worry. Okay, so Shriram is an employee of Reliance Industries Limited. Additionally, Shriram is also a shareholder of Reliance Industries Limited. He is also a shareholder. Without the ESOP, Shriram said that my company is doing very well. So as part of my investment, I think I should have in my portfolio shares of Reliance. So Shriram purchases shares of Reliance from the stock exchange. He places the order, he gets the shares in his demat account. It's a normal transaction. If currently I'm also an ordinary shareholder, okay, I'm also an ordinary what you can say buyer of shares, so I also place the order. So in the same capacity, Shriram also places the order for shares and gets say 10 shares of Reliance in his demat account. Now this transaction, what Shriram has undertaken, this transaction is not a share-based payment arrangement. This transaction is undertaken. I'll come to vesting conditions and all later. Okay, Haridan, I'll come to that. This transaction is not a share-based payment. Why, sir? Because Shriram has entered into this transaction not in the capacity as an employee, but in the capacity as a normal shareholder. Suppose Reliance comes out with a rights issue. Suppose Reliance comes out with a rights issue. A rights issue, as we all know, is always discounted to the market price. A rights issue is always discounted to the market price. That means what? Suppose the market price is 2,500, Reliance will issue the rights at 2,000 rupees. So, is Shriram getting the discounted price on account of him being an employee, or is he getting it on account of him being a shareholder? The rights issue is extended to Shriram, who is an employee, no doubt, but it is extended in his capacity as an existing shareholder. Similarly, the same offer will be extended to me if I am also the shareholder of Reliance. If Vivek also holds the shares of Reliance, Vivek also will get the same offer, even though he may be an employee of, let us say, TCS. So therefore, this discount is given to Shriram in the capacity of him being a shareholder. Rights issue is what? It is basically an option to exercise the price and you make the payment of 2,000 rupees. So you cannot say that it is an employee share based payment. This case, it is a plain pure rights issue without any share based payment arrangement, because Shriram has not provided any services as far as his shareholder relationship is concerned with Reliance. So therefore, you have to be very clear when we talk about an SBP that there must be a contractual relationship between the counterparty and the entity or another group entity which is issuing the shares or the payment based on share prices to the counterparty. There has to be a contractual arrangement. Okay, it cannot be any payment made, because there could be cases where one person could have two roles, as an employee or as a provider, plus he could also own shares in the company. Okay, so this is the manner in which your what you can say, your you have to differentiate. Okay, so coming back to our discussion, who is the counterparty in a share based payment arrangement? Okay, who is the counterparty? Employee is the counterparty in one case, or it could be parties other than employees. So I told you it's not limited to employee share based payment. It is related to just share based payments. So it includes employees and others providing similar services. Others providing similar services. Okay. So these individuals could be regarded as employees for legal or tax purposes, or the individuals work for the entity under its direction in the same way as individuals who are regarded as employees for legal or tax purposes. Means what? Substance over form. You suppose you have outsourced the accounting function to an organization. Those organizations people come and sit in your office to pass accounting entries. So it appears that legally they are employees of some other company, but because they listen to your instructions, they do the accounting the way you want them to do. So therefore, even they will be regarded as persons providing services which are similar to that of an employee. Okay, the services rendered are similar to those rendered by employees, and it includes all management personnel, even including non-executive directors. This is not my definition, this is given in the standard. So it's not strictly saying that the employee should be on the payroll of the company to categorize him or her as an employee. Not necessarily. Okay, he could be a person who is rendering similar services. Okay, so what you have to see is whether it is a contract of service or whether it is a contract for service. Okay, contract of service means an employee kind of arrangement. Contract for service is a professional arrangement, like how auditors and consultants give their services. Okay, so this is the meaning of employees. Now this definition, this segregation is very, very important. Why it is very important? Because the measurement date is different. Why? What is measurement date? We will come to that. But the date when you pass the journal entry in your books recording the expenses, that date itself is different for employees and other than employees. So therefore, this identification is very, very essential for us. Okay. So now coming to vesting period, vesting conditions, 2-3 definitions are there. Okay. Vest means to become an entitlement. Okay. See, an employer, Reliance, issues stock options to its employees. See, employee को मेहनत करना पड़ेगा. Employee must work hard, must give services to the entity. So once he gives the once he gives the services, he spends some time in the entity. जाते ही आपको stock option नहीं मिलेगा. The moment you are on the payroll, you won't get a stock option. Okay. Though the contract will tell you that you will be entitled to stock options, it comes with certain conditions. It comes with certain, it comes with certain requirements. Okay. That means it will say, for example, you have to be with Reliance for at least a 5-year period. Only then you will be entitled to exercise those options. So that entitled with certificate जो मिलता है ना आपको, that you can now exercise, उसको हम लोग बोलते हैं vest. We call that as vest. Okay. So vesting condition. So we call that as vest. Okay. Only when the options vest in you, only when the options become a part of you, that time only you can exercise the option. So you have to be entitled to the options in the first place. And when you will get entitled? Only when you provide certain services the way it is specified in the employment contract, the way it is specified in the stock option scheme. Okay. The vesting period in this scenario is the period during which all the conditions of a share-based payment arrangement are to be satisfied. So what are vesting conditions? Vesting conditions means you will have to fulfill certain requirements in order that the shares start to vest in you. For example, if you are an employee, a vesting condition could be that you must remain continuously employed with the organization for a period of 3 years. That means what? If you leave the organization before 3 years are complete, will you be able to exercise the option? Answer is no. Why no? Because you have not fulfilled the vesting condition. You have not fulfilled the vesting condition. Similarly, let us look at the other case. You finish 3 years and before you exercise the option, you leave. Okay. So therefore, I have a scenario like this. You join, you serve, and then you leave. Okay. So first case, this is your vesting period, which is a service period. I will just come. Okay. Which is a vesting period. 3 years. You have to remain employed continuously for 3 years. And after that, the options vest in you. The options vest. You become entitled. So therefore, if the employee leaves in this period, if the employee leaves, no options vest. If employee leaves. Okay. No options vest if employee leaves in the 3-year vesting period. After the vesting period, we have something known as an exercise period. Exercise period क्या होता है? आप exercise करो. पहले 3 साल exercise करने के लायक बनो. You become suitable to exercise. And thereafter, you can exercise. See, it's not an obligation on you to exercise. It is an option for you to exercise. See, suppose the share your exercise price is say 2000 and the share is trading at 1500 in the market, why do you think you will exercise? You will not exercise. You will say, यार तेरे से सस्ता तो market में 1500 में share मिल रहा है, तो I will buy the share for 1500 rupees from the market. I will not exercise your option. So it is an option of the employee. It's not an obligation. So in the exercise period, after you complete the vesting period and you fulfill the conditions, in the exercise period, you can exercise. Now I ask you guys a question. Suppose the employee leaves during the exercise period, resigns. Can he exercise the option after resignation? Can option, I'm just asking, be exercised after resignation? Okay, a very simple question. आपको समझा what is a vesting period? Certain vesting conditions I just introduced you. I know I have not done anything major. And then the exercise price. Now the question that I ask you is, suppose an employee resigns. He had not exercised the option. He completed the vesting period. Jab exercise period tha, that time he resigned. Now the question is, can the option be exercised after resignation? I am asking a simple question. इसमें कोई accounting नहीं है. It is a simple question. Okay. Okay. So I'm getting answers that no, the option cannot be exercised because he is no longer an employee. Okay. What about the others? I got 3-4 answers like this. Vivek is a very diplomatic person. वो बोलता है maybe yes, maybe no. Maybe yes because he is eligible. Maybe no because he resigned. यार तो आप ऐसे आंसर दे दोगे तो फिर यार एग्जामिनर को भी डिफिकल्ट हो जाएगा मार्क्स देने के लिए. ओके, पनु इज सेइंग यस, he shall be entitled to receive. Okay, what about Shriram? What about Nidhi? What about Uma gave the answer. Tushar, what about you? Asha, what about you? What do you think? See, I want you guys to think. Thoda socho. Shriram is saying he can exercise as a normal shareholder. So there is no option. See, as a normal shareholder, I have to go and buy at the market price. There is no question of exercising the option. Okay. So, bolo, who others? Asha is saying yes, he can exercise. See, you have to understand how the conditions are. See, employee ne mehnat kiya. Employee has given his service. He has given his blood and sweat. He has given everything to the company for the 3 years. So, when he joined, he was given the offer letter. Offer letter, what did it mention? You will be paid so much of salary. This is your CTC. This is your, what you can say, this is your payment. You will be entitled to stock options if you serve us for a continuous period of 3 years. This is the condition which is there. He now served you for 3 years. Agreed. After that, he resigns. But if he resigns, his resignation after 3 years cannot remove the fact that he has met the vesting condition. He has met the vesting condition. Yes or no? See, he is resigning in this period. He is resigning in this period. That means what? He has first completed this period. No, he has first completed this period. That means जो काम उसको करना था उसने कर दिया. I will just replace it by a fact that suppose instead of options, it was written that the employee will be entitled to a bonus of say 5 lakh rupees if he serves us for a continuous period of 3 years. So he resigns. That means what? वो bonus चला गया उसका? अरे नहीं, bonus मिलेगा उसको. He has worked for 3 years and and he will be entitled to bonus. Doesn't matter after the 3-year period वो resign करे या ना करे. That is irrelevant. The exercise period is at the option of the employee as far as what action he takes. It's not necessary for him to remain in service here. यहाँ पे it doesn't matter. He completed the vesting conditions. He can go to Reliance. He can go, in fact, immediately the next day after resignation and say, give me my shares. I fulfilled the vesting conditions. He can do that. Resignation does not matter. Resignation does not matter. He can exercise the option in the exercise period because he fulfilled the vesting condition of 3 years. Okay. He fulfilled the vesting condition of 3 years. That means if the employee leaves the organization during the vesting period, he cannot exercise, obviously, because the options are vesting in him. The options become a part of the employee only at the end of the 3rd year. So it is here that the options vest. For the options to vest, he has to render services for this 3-year period. Okay. तब तक वो नहीं ऑप्शंस वेस्ट नहीं होगा. वो बीच में 1 महीने के लिए भी वो रिजाइन करके जाएगा. He will not be able to serve. He will not be able to exercise the options because it requires, in our example, 3 continuous years of service. It requires 3 continuous years of service. The moment he completes the vesting period, your options have vested in the employee. अब वो कहीं भी जाए ना, उसके you can take it off like he on his t-shirt or on his shirt he will say options have vested वाला t-shirt पहन के घूमेगा और options उसको मिल जाएंगे after he completes the vesting period. Okay, so it is as simple as that. Which now brings us to another important concept. Now you tell me. Employee provides services. Employee provides services during the first 3 years. That means what? See, I have employee, I have company. The employee is providing the services to the company. In return, the company slowly starts getting obligated to issue shares or cash to the employee. Fair enough? So my question to you is, now please be very careful. We are entering our domain of expertise, that is accounting. Employee renders the service during which period to be entitled? Is it vesting plus exercise period or is it only vesting period? Sir, only vesting period. Exercise में कुछ भी करे, रहे ना रहे, he becomes entitled. So he provides the services during the vesting period and the company starts to get obligated. My question to you is, if employee provides the services to the company, in the vesting period, company should book the cost? Yes or no? Tell me. The company should book the cost. Sir, which cost? Employee remuneration cost. You are making payment in the form of stock options. So that is why the company should book this cost. When should it book this cost? Should it book the cost on the first day of the vesting period? I'm giving you 4 options. Answer carefully. The employee should book the cost for the options which it is giving. Now, when should it book the cost? Option A, on first day. There is a term for this. I will come to that. On first day of options. Or the company should book the cost on last day of the options. Or C, over the vesting period. Or D, during exercise period only if employee exercises the option. See, these are the 4 options. Okay, the questions are, see, the question is, employee renders services to the company during the vesting period of 3 years. After 3 years, the employee becomes entitled to the options. Now, if the employee becomes entitled to the options, company has to issue shares. That means company is getting something, and in return of that, company is issuing the shares. Yes or no? So the company, the employer, should recognize the cost of that services. Cost kitna hoga, kaise calculate karenge, that is a different part. We'll come to that later on. अभी के लिए हमें ये सोचना पड़ेगा कि कंपनी कॉस्ट कब बुक करेगी. Should it book the cost on the first day of the options, Lipika? Should it book the cost on the last day of the options? Because on the last day, I come to know who is actually completed the vesting period and who has actually completed the vesting period. So in the last day, I will book the cost. Or should I book the cost periodically over a 3-year tenure? Or last one, I will book the cost only in exercise period if the employee exercises the options. Okay. So now you tell me, if you are a company who has given a stock option scheme, which is the correct way of doing the accounting? जैसे ही मैंने options issue किए, first day only recognize everything. Okay. So give me the answer now. Okay, so Purnima, okay, gave me one answer. Shriram, yes. Okay, so Purnima, Janvi, Lipika, Namrata, Nidhi, Janvi. What about the others? Tushar, आपको क्या लगता है? Tushar, क्या नाम है? Tushar, Asha, Vidit, Viraj. What do you guys think? Come on. See, तुषार गर्ग, बताइए आपको क्या लगता है. विवेक श्रीवास्तव, आपको क्या लगता है? What do you guys think? Vidit is saying C. I have some people who are saying B. I have some people who are... Nobody is saying D. Nobody is saying D. Don't you think it should be D? Because I will be absolutely certain to whom I should give the... yes, I got somebody who said D. Great. Great, great, great. Okay. All right. I'm waiting for Anita to answer. I'm waiting for Asha. Asha gave her answer. Asha gave the answer. Panu gave answer. Yes, 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 yes. Excellent. Okay, fine. Now let us understand each of the options. Okay. What is the implication of that? If I book, nobody gave answer A. Nobody gave answer A, which is very good because I did not expect you to give, and I'm very happy you did not give. Okay. Why answer A is incorrect? Because on the first day when you give the options, you cannot book 3-year expense on the first day. Arey, that is very irrelevant. Matching concept hai hi nahi. Employee has not even started to provide the services and you are booking the cost on the first day. That is absolutely incorrect. So therefore, option A cannot be correct. Ignore that. Okay. There were some who said B. Yes. There were some who said, sir, we will go for option B. We will book all the expenses on the last day. Okay. What is the issue with that? See, the ones who thought last day of the options, I will book the expense, probably thought that, sir, on the last day, I will come to know how many employees actually continued for the entire 3 periods. How many employees actually continued to provide service for 3 years. So the people who gave me option B said that, must probably have thought, absolute certainty, guarantee जिसको हम लोग बोलते हैं, That guaranteed amount I will come to know only on the last day. And because I come to know that only on the last day, I should book the expenditure in the third year, at the end of the third year, So this is the thought process which students who gave the option B thought about. I totally agree with you. You are going with a very conservative and guaranteed and cautious approach, saying that I will book the expenses over the in the third year itself. But then what happens? Let me explain what happens if you do that. I have my P&L, right? So year 3, year 2, year 1. Okay. This is my particulars. So here you will have employee benefit expense. There won't be any expense here because as per option B, you have not year 3. There won't be any expense in year 1 because you want to be absolutely sure. There won't be any expense in year 2. But there will be a huge expense in year 3 because you are cumulating the expenses of year 1, year 2, year 3 put together. And that, my friend, is not acceptable from an accounting perspective. See, this expense is not arising in the third year. Your employee did not sit idle for years 1 and 2. In year 3, he suddenly cannot wake up and do a lot of work equal to all the 3 years. That is incorrect. Okay. So that is why I will not prefer option B. You will argue that option B hum karna padega, sir, because the remaining options, option 1 though is ruled out. Option C that requires booking of the expense over the vesting period, I cannot do that. Because year 1, I don't know who will fulfill all the 3 years. Year 2 में भी मुझे पता नहीं कौन छोड़ के जाएगा. Year 3 में I know the actual status. Doesn't matter. The standards, any accounting treatment for that matter, works on estimates. I think you would be familiar with this. Accounting and estimates. Accounting works with estimates. Estimates work with judgments. So therefore, you have to make estimates and do the accounting. Depreciation. मेरे को क्या मालूम asset का useful life actual में कितना होगा? Do I know? See, computers have a useful life of 3 years under the Companies Act. Do I know that machines will run for 3 years? If I take today's times, every year my machines are getting obsolete. You take a mobile phone. कौन सा भी फोन ले लो, 1 साल बाद व्हाट इज द वैल्यू ऑफ दैट? उससे अच्छे फोन्स उससे सस्ते दाम में मिल जाएंगे आपको. यस, सो व्हाट इज द रियल वैल्यू? You are losing your obsolescence. So you are losing the worth on account of technological obsolescence. But in spite of that, can I say that I will book it after 3 years, the depreciation, when the machine becomes obsolete? You cannot do that. You have to depreciate over the estimated useful life. So that is one estimate. Provision for bad debts, that is another estimate. Provision for obsolete inventory, that is another option. So you will not stick to the guarantee. You have the option of estimating the expenses. So therefore, I cannot go ahead with option B. Okay. So sir, ye wala option bhi gaya. Now we come to option D. Option D, you will book the expense during the exercise period only if employee exercises the option. If he doesn't exercise, I will not book the expense. So this is one way of thinking. This person who gave option D probably are even more cautious than option B. Option D में बोलता है my expense is going to be only for employees who exercise the option. क्यों? दूसरों ने काम नहीं किया क्या? They may not have exercised the options for various reasons X, Y, and Z, which I am not worried about. Those employees who served the vesting period and did not exercise the options, they have also ignored. They would have also provided services. You cannot ignore that. The fact that they did not exercise the option, we will look at some other accounting treatment for that. But did they provide the services then? Yes. So you cannot have a service being booked in the exercise period because the service booked for getting the ESOP was already done during the vesting period. So that is why this option also ends up becoming irrelevant. So the right option, which many of you have given, is exercising over the vesting period. Booking the expense over the vesting period, right? So you have to book this expense starting right from year one. Starting right from year. Sir, how will I know how many employees will remain at the end of year 3? I don't know. That is the estimate you have to make. You have to record based on an estimation. That is the first thing that you will have to do. So therefore, I hope that you are now convinced that year 1, when I book the expense, it will be on an estimated basis. Year 2, I will book for year 2 based on an estimated basis of employees who will continue up till year 3. End of year 3, I know the actuals. I will subtract year 1 and 2, whatever I have earlier booked, because it goes on a cumulative basis. And then year 3, I will get the expense. And that is how the employee benefit expense will be recorded. Okay. So in the options, in the course of explanation, many people had answered. So Tushar, Viraj and Panu, I hope you are convinced why it is option C. Uma, I hope you are convinced why it is option C. Rest, Namrata, Shriram, Vidit, Asha and Janvi, Nidhi. Okay, fine. You were the guys who gave option C. Okay, so doesn't matter. It is a process where you guys sit to think. Okay, so it's interesting. At least glad that all of you attempted. Yes, Kayuri also gave the right answer. Okay, so good. I'm happy. Anita, I hope you understood. Okay, so yeah, so that's about it. So anyways, so we will do the booking of the expense over the vesting period only. Uske baad we are not giving options. Employee will say, मैं इतना मेहनत क्यों करूं? So therefore, after that, there is no options. Okay. How to measure? I have still not yet come on that. Okay. So we'll come to that slowly बढ़ते आगे, right? So vesting period we saw the implications of vesting period. Okay. What is the implication? Expenses are booked during the vesting period. Sir, to make an estimate, which base should be considered? It depends. You will have to take a call. You will see, probably generally how organizations do is when they make an estimate, and this is where things start to get very interesting. Okay. See, I'll just deviate just allow me to indulge myself for 2-3 minutes. Okay. See, can the organization say, I'm just going ahead, and can the organization say in year 1, sir, I don't expect that any of the employees will stay for 3 years, and therefore I will book nil expense. Can the organization say like that? Be fair enough, be true, and just tell me, can an organization tell that? Bolne ki baat hai. Can the organization tell, we do not estimate that the employees will complete 3 years of service, and therefore I will not book any expense because I do not expect these options to vest. Can the organization say like that? Bolne ki baat hai. Bol sakte hain. They can tell that. Surely they can tell. Kab bolenge? When do you think the organizations will make such a statement? They will make such a statement when the profit for this year is low. So they want to find creative ways to inflate the profit. And the most common way to inflate the profit, is to play around with estimates. See, there are various ways you can do frauds, but the most common one is estimate frauds. Okay, that means you play around with estimates. And when you play around with estimates, you can always say in the future, वो estimate था, अभी ये हकीकत है, तो अभी मैंने book कर दिया, right? So therefore, you will always make what you can say. You will always say that it was an estimate in the future. So that was the estimate. This is the reality. So there is a high chance that entities may start messing up with the estimates that are being made. That is a possibility which is there in these kind of accounting treatments. Even when you do Ind AS 19, that is on employee benefits, there also you have estimates being done. So therefore, there also you can play around. So profit can be inflated by giving such ridiculous reasoning that I don't expect anybody will continue for 3 years. Highly irrational statement, but it can be done. So to answer the question, what is the base? What is the base? To answer that question, the base should be take out the previous period's data, look at the average employee attrition rate in your company. See, somebody who has completed say 10 to 12 years, उसके लिए कौन सी बड़ी बात है 3 साल काम करना. So you can consider that that employee will remain for 3 years. So it is an estimate. Be a little bit realistic in your estimate. In your own organization, look at the average tenure an employee works. Look at the average tenure a newly joined employee works. A fresh employee will typically work for at least 3 to 4 years in a company. And that point of time, you cannot say that I don't expect anything. Okay. So as a company, your estimates will be based on past data, the trends which your employees follow as far as the what you can say, as far as the resignations, attrition is concerned. So that becomes the base for deciding how to book the expense. Okay, sir, will the booking of expenses continue in year 4? No, because the options have already vested. See, year 3 options have already vested here. Now year 4 में काम करने से he is not going to get extra options. तो वो बोलेगा मैं मेहनत क्यों करूं? Why should I work so much? जो मिलना था वो मिल गया. अभी आगे में I'm going to get only cash. I'm not getting options. So therefore no options, no vesting conditions, no expenditure. Expenditure will be booked only during the vesting period. Okay, so for auditors also, these estimates become problematic. Okay, if you recollect, or I don't know if you have yet studied, there is a standard on auditing, SA 540, that deals with what? SA 540 deals with auditing accounting estimates, including fair value estimates. Okay, so all these estimates which an entity makes in the preparation of its financial statements, you have to question. If they say employees will leave, ask them basis kya hai? Pull out the old records, check the fresh records, check the average tenure. Okay, everywhere, wherever you see estimates, you have to ensure that you do if you are going into the assurance industry, you have to ensure that you follow whatever is there in SA 540. You cannot say I take a management representation and काम हो गया. ऐसा नहीं चलेगा. Suppose the management estimate says we do not estimate that anybody will exercise, and in the company everybody is there for more than 10 years. Then you have violated the estimate, na? And when you have violated the estimate, how can you say you've done the audit correctly? Yes. So estimates, I mean, you cannot take management representation as the basis for estimates. You have to test the veracity of those estimates. That is what SA 540 wants us to do. Okay. So anyways, that is a separate discussion. So now coming to our discussion, vesting period, you book the expenses here. In the exercise period, you do not book the expenses. Okay. So what is exercise period? This is the period during which options can be exercised and shares can be purchased. I gave you that. Okay. And I have also mentioned this for you. An employee who leaves the company during the exercise period will still be entitled to the options. Will still be entitled to the options. Okay. So this, what all we, so just sit, listen and understand. Whatever I am speaking is all there here. It's just that you have to understand what I discuss. Rest, whatever you go through, you will be in a position to understand. Okay. Now coming to fair value. Okay. If you recollect, we had just done Ind AS 113 2 days ago. Okay. Yesterday and day before. Okay. If you recollect Ind AS 113, there was an exclusion there. सर एक्सक्लूजन था हाँ, दो एक्सक्लूजन थे, नॉन एप्लीकेबिलिटी as far as what you can say, as far as only disclosure were concerned and as far as measurement and disclosures were concerned. Can you just quickly refresh your memories or the notes which I have shared with you on 113, and can you tell me Ind AS 102 falls under which exclusions for 113? Quickly go to your memories and please tell me. Ind AS 102 was there under the non-applicability. Was it not applicable for fair value measurement, and was it not applicable for measurement and disclosure both, or disclosure only, or measurement and disclosure both? Come on, tell me. Quick. Where do you see the non-applicability? I hope you got my question. Measurement and disclosure. Absolutely right. So I just have this standard, the bare standard, which is there for you. You can see it is mentioned here. The standard uses the term fair value in a way that differs in some respects from the definition of fair value in Ind AS 113, fair value measurement. Therefore, when applying Ind AS 102, an entity measures fair value in accordance with this standard and not Ind AS 113. So therefore, here the fair value is defined. The measurement is defined. Everything is defined here, and that is why we will not refer to fair value measurement. We will not refer to the standard on fair value measurement. We will stick to this standard. तो Ind AS 102 के लिए please भूल जाइए कि आप Ind AS 113 पढ़े थे. Okay. So now coming back to our presentation. Fair value of an option. What is fair value? It is the value which is calculated using an option pricing model. So you'll study option pricing models in your SFM. It could be like the binomial model or the Black-Scholes-Merton model, if traded options with similar terms do not exist. So it says that you take the help of an option pricing model if similar options do not exist in the market. Okay. So all the option pricing models must consider at least exercise price, life of the option, current price of underlying shares, expected volatility, dividends if appropriate, and risk-free interest rate. So this is just for your information. Okay. Intrinsic value is current market price minus exercise price. I will come to this when we do the accounting. Okay. So this is fine. Yes. All right. Okay. So far, is it okay? We've still not yet come to problem solving. I will come to that, but once the concepts are clear, we can start with the problem solving. Is it okay? So far, are you guys able to understand, able to follow? Are you finding it interesting? Are you finding it boring? Yes. Is it okay? Yep. Ind AS 102. Okay. All clear so far? No theory questions. No theory questions. But what I can tell you with certainty is, by studying this theory, you will find the practicals to be very simple. It's just a matter of solving problems, which I will be taking you through. Okay. So what is a vesting condition? It is a condition that determines whether the entity receives the services that entitle the counterparty to receive cash, other assets, or equity, whatever it is. Okay. So what is a vesting period we saw? Now vesting period in our example, I'll come to certain practical questions, Vivek. Okay. Now a vesting period could come with certain conditions. Okay. Like in our example, you have to serve for 3 years. If you serve for 3 continuous years, the options get vested in you. So we call that a service condition. Okay. So that is a vesting condition. You could have a performance-based vesting condition. Sir, what do you mean by performance-based vesting condition? These are conditions like, if the company sales achieve, say 500 crores, then the options vest in the employees. So that becomes a service condition. That becomes a performance condition. Sir, which type of performance condition? There are 2 types. One is a non-market condition. The other is a market condition. Non-market condition, typically these depend on the factors which are within the control of the entity. Like, for example, what you can say, turnover of the company. It is within the control, so turnover is there. Gross profit margins of the company, EBITDA margins of the company, net profit of the company. Okay, so all these are my performance conditions which are based on targets achievable by the companies. So we call that as non-market conditions. Non-market conditions. You fulfill the non-market conditions, the options vest in you. You do not fulfill the non-market performance conditions, options will not vest in you. Okay. And then you have something known as a market condition. Like, for example, the share price becomes so and so amount after 3 years. If that is the case, then you are going to get the options. So these are market conditions. The accounting for non-market conditions and market conditions is different. So please do not worry about that. Okay. Condition not satisfying the above is a non-vesting condition. Okay. So this we will see it later. Okay. Okay. So vesting conditions, I discussed what is a service condition, what is a performance condition. Okay. So performance condition could be a service condition plus performance targets. Okay. So you remain in service plus fulfill the performance. Okay. So this you can go through it. I have discussed service versus performance condition. Go through these differentiations. I have given it to you for your reference. I have again explained market condition kya hai, what is a non-market condition. I have explained to you. Okay. And the differentiators are there for you. Okay. So this is what we have discussed so far. Okay. So if we look at the decision tree, the condition determines if the entity receives the service against the share-based payments. If no, then it is a non-vesting condition. This we will see it later. Okay. Right now, the important ones are vesting conditions. So if the condition determines whether the entity receives the service, if the answer to that is yes, does the condition require only period of service to be completed? Yes, our example 3 साल खत्म करो आपको stock options मिल जाएंगे. So then if that is the only condition, then it becomes a service condition. If not the only condition, then we have performance condition. Is the target based on share price of entity or a group entity? If the answer to that is yes, it becomes a market condition. If no, then it becomes a non-market condition. Okay, so this is how you will evaluate. So go through these examples, analysis of vesting conditions. These are just examples which are there, no great things to discuss in that. Okay, now coming to the figures and the numbers and whatever is there. Okay, so the first and the important definition for accounting. Okay, fine. Now coming to questions. Sir, in the real world, how do companies manage these transactions where employees continue to join and leave? This is a question by Vivek. Okay, so you see, in large companies, you typically have these payroll and HR softwares that take care of the estimates and workings for you. I'm not saying they do 100% accurate job or their estimates are right, but at least they give you a sense of analysis, patterns, trends, etc. If you are interested, you can just see that we are increasingly gaining insights through data analytics, where you notice the patterns. Patterns are there everywhere. Okay, an employee leaves, joins, leaves. So his pattern of employment we come to know. We also come to know. So everything is kind of, what you can say, automated, or you can get the data. Like for example, when you hire an employee, on his CV, he will surely mention the past service experiences. So from that, you get an idea whether he's a job hopper, 1.5 to 2 years, 2 to 3 years, 3 to 5 years. So from there, you can make an idea of how this particular person's pattern of shifting the jobs is. And this is taken care by the softwares which are present. Okay, so when the softwares take care of this, you get a series of patterns across the organizations for each of the employees. So you just, put in the options, filter the name of employees to whom you are giving these options. You get a beautiful estimate of who could be there, who could not be there, etc. based on which you could do the accounting. Okay, so high-end companies have these kind of high softwares. In small companies, say a turnover of a few hundred or thousand crores, typically this is managed manually by the HR department. Okay, so that is how these are done. Okay, sir, how to determine the base for fair value measurement? Is it industry specific? Base for fair value, as they said in our example, if you have traded options with similar terms, you can consider pricing the options at that level. However, if that is not there, you will have to follow an option pricing model. So those could be the binomial model or the Black-Scholes model. In 113 terms, these are my unobservable inputs. Okay, because they have to consider your life, your price, whatever is there. So it is absolutely unobservable. So there is the base could be the outlines which they have given, the 4 to 5 things which they have given. Okay, so anyways, that is the questions which we had. Okay, coming back to our discussion on the topics. Okay, now grant date. Grant date is what? This is where we start coming to the numbers now. Okay, grant date is the date when both the parties, the entity and the counterparty, have a shared understanding. Shared understanding means consensus. Have a shared understanding means consensus. And it occurs only on agreement. That is, offer and acceptance both should be fulfilled. Offer and acceptance both should be fulfilled. The acceptance may be explicit or implicit. Fair enough. And if that agreement is subjected to an approval process, Sometimes shareholders approval is needed, because ultimately what happens if you go for ESOPs, the existing shareholder stake will be diluted. So for that purposes, the existing shareholders approval is taken, and if that is the case, then the date of that approval will be the grant date. So very simple. Grant date is the agreement date. For agreement, what you need? Offer and acceptance. But where you need shareholders approval will be the grant date. Okay. So at the grant date, the entity gives the options to the to the counterparty, provided they give the services or cash, or services or assets, whatever it is. Okay. So this is how you will evaluate the meaning of grant date. Okay. And then we come to measurement date. Measurement date मतलब कौन से date पे हम measure करेंगे. What is the date when we measure? And here it is important to distinguish between who are my employees and who are other than employees. Okay. So for employees, the measurement date becomes the grant date. That means as on this date, you will start measuring the worth of the options. Whereas in the case of other than employees, the measurement date will be the date on which the entity obtains the goods or the counterparty renders the services. Okay. So coming back to our discussion, this date is my grant date. This is my grant date. Okay. On this day, you give the grant. Now, for the purposes of measuring the benefits which you have given to the employee, the measurement date is going to be the grant date. Sir, why the grant date? How can you say that the employee provides services on this date, this date, this date? वो तो बेचारा रोज आएगा, रोज काम करेगा, रोज जाएगा. So it is very difficult for the entity to say that on this day, he provided services related to stock option. On this day, he did not provide services related to stock option. How are you going to differentiate? You cannot differentiate in a stock option plan given to employees. Very difficult. So therefore, the standard makes our lives easy and says that the measurement date will be the grant date. Fair enough. Whereas the other side, you have the non-employee category. Uska to simple hai na yaar. When that entity provides the services or gives the goods, that is identifiable. वो one-off transaction hai. So when they give the goods or provide the services, that is the date you will do the measurement. In employee, it is not possible. So therefore, measurement date is equal to the grant date. So I hope you guys understood that. Okay. I hope you guys understood that. Yes. So what is covered under Ind AS 102? Finally, we come to the scope of Ind AS 102. You have equity settled payment transactions. That means you issue equity shares. You have cash settled share-based payment transactions. That means you have an obligation to deliver cash. You have share-based payments with cash alternatives. So these are kind of compound financial instruments. Okay. Similar to CFIs. Okay. And then what is excluded? Certain group SBPTs. We will see that when we do group transactions. Transactions with equity holders. I told you employee in the capacity of shareholder, you give rights. So therefore they are excluded, and transactions covered by other Ind AS. Okay. So this is all what is there, what you will have to go through. Okay. And now coming to journal entries, it is very simple. Debit will be what comes in, which could be the assets, or if it is a service, you debit the expenses. Credit will be if you are issuing equity, it will go to equity. So recognize the credit in the equity. And if it is cash, then recognize increase in liability. That means this is stock options and this is stock appreciation rights. Okay. So in simple words, the journal entry will be expense or asset account debit to equity if you are giving shares, or to liability if you have an obligation to deliver cash. Okay, so this is the entry that will be there. Sir, everything is done. Everything is done. अभी आप मेरे को बताओ क्यों करेंगे और कितने अमाउंट पे करेंगे. Lot of theory we discussed. 1.5 hours we are shouting. Tell me everything. Okay, so now this part we have discussed. Okay, so what is mentioned in para 9? Services consumed immediately or goods used consumed over a period of time, acquiring goods, whatever it is, entity will recognize expense or asset and recognize liability or equity accordingly. Okay, so go through this, and now we come to the measurement principles. Okay, see, the standard goes something like this. Okay, this is the last part of discussion. Then we go to problems only. I know the dose of theory has been too high, but I could not help it. Okay, so suppose, let me make it this way. Okay, suppose who is the person here? Vidit. Okay, Vidit has his own क्या बोलेंगे, has his own accounting team. Okay, not accounting team, I will make it different. Vidit has his own printing press. Okay, Vidit has his own printing press, and there are certain what you can say, certain requests made by Reliance to print banners. They recently came out with the Nita Mukesh Ambani Cultural Centers. So they wanted to print banners for advertisements and put up the hoardings, etc. everywhere in Bombay. So they hired Vidit's firm, which is a well-known printing press. And in return, what Reliance Industries Limited said that we will give you shares of Reliance. We will give you shares of Reliance Industries Limited. So now, is this a share-based payment transaction? Yes, it is a share-based payment transaction. Vidit is going to give the services of printing the banners, and Reliance Industries Limited is in return going to give the shares. Is this employee share-based payments? Answer is no, because Vidit is going to decide what computers he will use, what printing machines he will use, on what surface he is going to print, which inks he will use. Okay, all this he will decide. He has only received the structure, and he has been given certain instructions. That means wo raat mein dikhne chahiye, it should be flashy, it should be like these colors should be used. That's it. Okay, so basically Vidit is not rendering any employee related services. These are other services. Okay, so that is fine. Now, when Vidit renders these services to Reliance and Reliance issues the shares, dekho, expenses, Reliance will pass the entry printing expenses account debit to equity share capital. The question is, kaun se amount pe? At which amount? And then what do you guys think? The standard tells here, if it is other than employee services, the measurement date will be the date when you receive the goods or services. You can refer here. I have shown you the measurement date is going to be the date on which the entity obtains the goods or the counterparty renders the services. So here, suppose Vidit gives the printed banners to Reliance Industries on the day he is studying this. Okay, so 20th April 2023, he gives the printed banners. So Reliance Industries Limited will measure this transaction on 20th April because that is the date when you have received the banners. First point. So the journal entry will be passed on 20th April 2023, which is what we do for all our goods and services. In the factory, when you receive the goods, that time you book the invoice. You never book the invoice before you receive the goods, right? So that is the first part. The next part that I am having is, at what amount? At what amount? And the standard tells, if the fair value can be measured, then it will be directly at that value. Entity shall measure goods or services received and corresponding equity directly at the fair value of goods or services received. So because of the material, the banners, the content that he used, the market value of that, Vidit had just done a similar order the last week for another company, and that amount was, let us assume, rupees 10 lakhs. Let us assume that the order for that is 10 lakhs. So what will be the accounting price at which the entry will be recorded? Sir, I will record this at rupees 10 lakhs. I will record this at rupees 10 lakhs. This is how you will do the accounting treatment. Okay. Where it is other than employee services, then you will record it at the fair value of goods or services received. Acha, sir, agar fair value nahi malum of the goods received, first point, or if he is an employee. Coming back to our example, I think Sriram was an employee of Reliance Industries. He's a very sincere and diligent employee, and he's providing services. Abhi, how am I going to quantify the services provided by Sriram to Reliance? I cannot. It is impossible. Yes, because he may do reporting on one day. He may do certain tax matters on another day. He may handle an internal audit function the other day. On the fourth day, he may do some other management related requirements. Okay. So his requirement, his service that is provided is very different. Exactly my point. You will get an invoice in this case from the supplier for rupees 10 lakhs because that is the fair value of goods or services that is provided in the example of the printing of the banners. But in this case, employee cannot raise an invoice. Employee kaise dikhayenge hum? So therefore, in this case, the measurement will be based on the fair value of the shares which are being issued. Dekho, the transaction has two parts to it. It is services received or payments made in the form of shares. So the first preference to non-employees is fair value of goods or services received. If this is not possible, and for employees this is to definitely not possible, then it will be based on the fair value of the options which are issued. It will be based on the fair value of the options which are issued. Is it okay? So that is the reason whenever you will do the accounting henceforth, we will always take it at fair value as far as employees' options are concerned. Because I cannot measure the value of services that they provide. I cannot measure that. Okay. So today X is an employee in Reliance. Y is an employee in TCS. How can I compare? I cannot compare that. So therefore it will be based on the fair value of instruments issued. अभी आ रहा है? Okay. I'm sorry, I think we lost the audio in between. Okay, some technical issue. I pressed something by mistake. Okay, am I audible now? I think it's audible now. Okay, so what I was, now where was I? I think we lost track. Okay, so basically when employee renders the services, the standard has said you cannot measure the fair value of that. You cannot say when he provided the services because it is over a 3-year period. So for that, you will take the fair value of the equity instruments or the options which are issued as on the grant date. That is how you will do the accounting. Whereas in the case of normal suppliers giving goods or services, the measurement date will be the date on which you receive the goods or services, and the measurement amount will be based on the fair value of goods or services received. If that is not reliably measurable, then it will be based on the fair value of the equity options which are issued or the options which are issued. Okay, so that is how you would do the accounting. Okay, so there is no arm's length here. The arm's length was there in here. There is no arm's length, Panu. Okay, all right. So this is how you will do the accounting. Okay, all right, fine. Now we shall come to problems. Okay, now after all these things, let us come to solving the problems. Okay, I will take you through the workings. I will discuss the questions so that we can understand how the workings happen. Okay, and we'll try to have some defined formats, of course, so that things become easy for you to implement. Okay, so important things: employee stock option plan, grant date is the measurement date, fair value on the grant date is what you will consider. Okay, couple of points are there. I will discuss it as we do the questions. Okay. Important one is, I'll just note it down. I'll discuss this later. Okay. In case I forget, you will have to remind me. Change in fair value of equity options. Okay. All right, fine. Good Luck Limited. Okay, so now we start this. Okay, it's fairly simple now. You know all the things which we had to discuss, so there is no doubt, absolutely. So now let us start the questions. Good Luck Limited grants 180 share options to each of its 690 employees. So what is the total options granted? 690 into 180, 1,24,200. I'll give you 5 minutes break. Let me do 1 or 2 questions, then I'll give you a 5 minutes break. Okay. Each grant containing the conditions on the employees working for Good Luck Limited over the next 4 years. That means this is a service condition. This is a service condition. Okay, you can have your calculators next to you. So Good Luck has estimated that the fair value of the option is rupees 15. This fair value will always be given to you in the question. Okay, and the valuation of options will always happen at fair value. It won't happen at intrinsic value. So the next part I have to discuss with you is what is intrinsic value. I will discuss both of them later. Let me do 1 or 2 questions because too much of theory is done. Okay, all right. Now, Good Luck also estimated that 30% employees will leave during the 4-year period, and hence it will forfeit their rights to the share options. So what should be the expenses to be recognized during the vesting period? So very simple, you take 690 employees into 180 options into 70%. So that comes to 86,940. Fair value per option is rupees 15. So 86,940 into 15 gives you this figure. Are you all able to understand till now? Are you able to follow till now? Yes. Are you able to follow up till now? Bolo yaar. Did you follow? Okay, fine. So very simple. This is 4-year expense. Okay. 13,04,100 is over the vesting period. Over vesting period. Okay. So amount expected to vest in year 1 is obviously going to be 1/4 of that. So 3,26,025. Okay. So this is a very simple question. No problem in that. Okay. I hope you understood. Yes. And then we move on to the next question. Just 2-3 questions, then I'll give you a break. ABC Limited granted to its employees share options with a fair value of 5 lakhs. So this is given to you on 1st April X0 if they remain in the organization up to 31st March X3. So you have a service condition of how many years? 3 years. You have a service condition of 3 years. Okay. X0, X1, X1, X2, X2, X3. Okay. On 31st March X1, that is end of year 1, ABC expects only 91% of employees to remain in employment. So what is the total value of options expected to vest? Well, they expect 91%. So the total value expected to vest is 5 lakhs into 91%. 5 lakhs into 91%. But sir, this is for a period of 3 years, no? Yes. So you have to book expense for only 1 year. So 1/3. So 4,55,000 into 1/3. So that gives you 1,51,667. This is proportionate cost for the year. Okay. You can call this as cumulative. So what is this one? What is already recognized in previous years? Nothing. Ye to first year. So this is 0. So amount to be expensed in the current year is 1,51,667. Did we understand the first year's workings? Did we understand first year's workings? Yes. Have we understood first year's workings? All right, good. Now you come to the second year. Sir, second year also will continue with the same? No, estimates can change. So on 31st March X2, company expects only 89% to remain in employment. Fair enough. So therefore, this will be 5 lakhs into 89%. I'm just replacing this here for our understanding. Okay, 5 lakhs into 89%. So that comes to how much? That comes to 4,45,000. And 4,45,000, sir, this is for a 2-year period. X0, X1, X1, X2. So 4,45,000 into 2/3. So that comes to 2,96,667. 296,667, out of which I have already recognized 151,667 in the previous year. So therefore, current year, how much should I recognize? 1,45,000. Current year, I will recognize 1,45,000. Just do the calculations and just let me know whether you have understood this. Let me know whether you have understood this. Yes, we are taking a prospective effect for the change in accounting estimate. We are taking a prospective impact for change in accounting estimate. Second step understood. Okay, fine. Coming to the third step, this is the actual one. So 82% of employees remained in the organization. So 5 lakhs into 82%. This is the last one. Okay, 4,10,000. So this is 4,10,000. 3 years have passed. So into 3 by 3, 4,10,000. Till date, you have recognized 2,96,667. So in the last year, how much are you going to recognize? Sir, we will recognize 1,33,333. Basically, we are doing a cumulative catch-up adjustment and subtracting whatever was recognized up to the end of the previous year. So that will give the expense for the current year, which is exactly how prospective treatments are done. You basically take expense for the total period, subtract what was recorded up till the previous year, and that will give you the expense to be recognized for the current year. Okay, so that takes care of our expenses. I will be therefore recording 1,51,667 in year 1, 1,45,000 in year 2, and 1,13,000 in year 3. Have you understood? Shriram, Namrata, Uma, Asha, Vivek, Tushar, Panu, Nidhi, Janvi, और कौन है? Viraj, Vidit, Anita, did you guys follow? Yes. Okay. So now you will be able to appreciate the question which I had asked as to when should the accounting for the vesting conditions be done. Should I record 4,10,000 entirely on year 1? Answer is I cannot. चाह करके भी मैं नहीं कर पाऊंगा because I don't know the actual status at the end of year 4, at the end of year 3. Should I book entire 4,10,000 in year 3? Answer is wrong. You will have 0, and you will have 4,10,000 in that case, which is not right because employee did not render services only in year 3. He has rendered services in year 1 and year 2. And that is why we do the accounting in this particular manner. So the entry that you are going to pass is employee benefit expenses account debit, which goes to the P&L, unless it is related to construction of an asset, in which case it would be capitalized. To share-based payment reserve. See, in your guidance note, in the chapter on accounting, which you studied in your intermediate, in that you used to take it to stock options outstanding, if you remember. Okay, you used to take it to stock options outstanding. यहाँ पे हम stock options outstanding में नहीं ले जाएंगे. We will take it to SBP reserve. Sir, दोनों में फर्क क्या? कोई फर्क नहीं. There is no difference between both of them. Sir, then why not stock option outstanding? ऐसे ही कुछ तो difference होना चाहिए ना. When you come to final, intermediate का ही चीज follow नहीं कर सकते. We do something extra, something sophisticated. So we take it to SBP reserve. Basically, what I want to say is stock option outstanding and SBP reserve are one and the same. There is no difference between both of them. Okay. So P&L. All these expenses will be transferred, and ultimately when the employees exercise, it will be share-based payment reserve account debit to equity capital / securities premium. I do not know now whether shares are at par or premium. So therefore we write both the things. Because they're not given the issue price, they've not given number of shares, they've not given face value, nothing is given. So you take it as SBP reserve account debit to equity share capital / securities premium. Okay, fair enough. Is it clear? If after third year तो देखो इधर क्या है, they have to remain in service up to 31st March 20x3. मतलब end of the third year, you guaranteed know how many employees are there with you. See, this figure 91% is estimate. This is estimate. 82% is not estimate. This is actual. Okay. The 82% in year 3, the rate which we are having, how many employees have satisfied. The third year, end of third year, it is absolute actual guaranteed figure. Okay. Year 1 and year 2 jo hai, these are projections. These are projections. Look at the wordings in the question. On March X1, ABC expects only 91%. So this is estimate. March X2 expects only 89%. And if you see the third year, only 82% remained. That means this is not an estimate. This is not an expectation. This is actual. This is actual. Okay. So you read the question, you will get to know that how the question is flowing. Okay, fine. So this is actual. All right, fine. So that takes care of 2 questions of ours. Good. So now what we will do is we will take a break of 5 minutes. It's 8:50. We take a 5-minute break and then we move on to the next problem, which is a fairly important one. Okay. All right. Take a 5-minute break, please.
Okay, fine. So welcome back. Yeah, today's notes I've uploaded as I said last night, but you should be getting it shortly. Okay, maybe by today first half it should be loaded. Okay, so you'll get it then. All right. So let us then proceed to the next part. Uh, Okay, so I will leave slide number this question for homework. Okay, slide number 49 is the slide of this question, this sheet. Okay, so you can see the slide numbers given on the lower right bottom. So there I have given the question reference. Okay, and 49 I have referred to page number 5.73. That means this is an ICI test your knowledge question. So it is done for you. So therefore you can refer. Page numbers may be plus minus because the study module keeps getting updated for printing and formatting. So therefore thoda upar niche ho sakta hai. Ho gaya to just bear with it. Okay. So that is something. So I will be leaving this for homework. Same question like the earlier one. Only thing is instead of 3 years, it is 2 years. That's it. There is no other change. So you can see total options granted, percentage of employees expected to vest, fair value per option, fair value of options expected to vest, proportion of expenditure, cost minus recognized previously, expense for the year. Okay, so it's exactly the same. There is no difference in this whatsoever. Okay. So now coming to this question. Okay, now this questions is from the earlier syllabus. Okay, that was there, but it is nevertheless an important one. Okay, so now we will be taking these two questions and that completes our, see in examination, if they tell you to write journal entries, it is understood that you give the narrations. Okay, so you have to give the narrations for that. Okay, so now let us start discussing the next question. These are old syllabus. They are not there in your current study module, but they are very important questions. So I think that you should be able to solve this. Okay. So the following particulars in respect of stock options granted by a company are available. The plan covers 525 employees. Okay. Number of options per employee is 100. Vesting condition is a service condition requiring continuous employment for 3 years. Okay. Nominal value per share. Nominal value means face value. Okay. So we can calculate the premium also. So this is 100. Vesting period is given to you to be 3 years. Exercise period is given to you as 1 year. So therefore, if I plot my total option tenure, it is 3 years plus 1 year for exercise. So therefore, I give the option today. The life of the option is totally 4 years, which includes 3 years vesting period. So there you book the expenses. After that 1 year is exercise. If any employee does not exercise the option, the options will lapse after a period of 4 years. The options will lapse after a period of 4 years. Lapsing mein kya karna hai? We will have a look at that. Okay. So now fair value of options on the grant date is rupees 30. And exercise price per share is rupees 125. At the end of year 1, estimated annual rate of departure is 2%. That means in the next 2 years, they are expecting 2% employees to leave. Number of employees actually who have left is 15. So how does the working flow? Just pay attention to this. Year 1, you pay attention. 2 and 3 is a repetition. See, I gave the stock options to 525 employees in the beginning. Okay. Out of 525, how many have actually left? Sir, 15 have actually left. This is not an estimate. This is actual. Okay. This is actual. Okay, so 525 minus 15 at the end of year 1, I am having 510 employees remaining. Now, 2% are expected to leave in the coming years. 2% are expected to leave in the coming years. That means what? At the end of year 2, I will be having 510 into 98%. I will be having these many employees, 510 into 98%. And at the end of year 3 will be end of year 2 into 98%. That means 510 into 98% into 98%. So I hope you have understood this calculation, why we have taken 98% twice. Why we have taken 98% twice. Is it okay? Yes or no? Please tell me. Have you understood this 98% twice? Yes. So 510 actual employees, I expect 2% of that to leave at the end of year 2 and 2% of year 2 to leave in year 3. So 510 into 98% into 98%. Have you understood this part? Yes? You did not understand. Okay, fine. Let me draw this for you. See. Year 0, year 1, year 2, year 3, 4. On this date, I am having 525 employees. Okay. On this date, I am having 525 employees. So I gave options to them. I gave them options. Now, what is the condition? These employees must remain in service for 3 years. So, इसको हम लोग बोलते हैं vesting period. The condition is any employee who remains in service for the 3-year period will get the options in year 4, will get the right to exercise the option in year 4, which is okay. Fine. Now, year 1 passed. Year 1 mein, how many employees actually left? Sir, in year 1, 10 employees actually left. 10 employees actually left. So now please pay attention. I had 525 at the beginning. 10 have, not 10, sorry. How many left? I think 15 left, no? Yeah, sorry, 15 left. Okay. Yeah, 15 left. So I have 510 employees. Is this 510 employees clear to everyone? Yes. Are you sure about this 510 employees? Yes. Just answer one question. I will come to know whether you've understood or not. Is this 510 actual number or is this an estimated number? Just tell me this. Is this 510 actual or is it an estimate? $510, is this actual or is this an estimate? Bas itna sa bata do, then I will take the explanation forward. Great. Everybody says, no, Asha, this is not an estimate. This is actual. Look at the question. See, position at the end of year 1, number of employees left. This is not an estimate. See, this is actual. Okay, this is actual. Okay, so this is not an estimate. 15 employees actually left. Okay, so 510 is my actual number of employees who are there. Okay, so I hope you have understood that. Now the question is, I have to book expense in year 1. I have to book expense in year 2. I have to book expense in year 3. Correct? So now if I have to book expenses in all these years, I should estimate. I should now see, be careful. I will write it with a different pen. I should estimate I should estimate how many employees will remain in year 3. मुझे इसका estimate करना है. I have to estimate this. When will I estimate? When I am booking the expense. When am I booking the expense? Sir, I am booking the expense here at the end of year 1. So I have to estimate. So what is the annual rate of departure? Sir, annual forfeiture expected. That means expected annual rate of departure is 2%. This is annual. That means every year. So I am in year 1. I have to look at year 3. That means here I expect 2% to leave the organization, and here I expect a further 2% to leave. It is annual. It is annual. So what happens is 510 is my actual. This is actual. Departure. This is an estimate. 2%. So 510 into 2%, that gives you how much? That gives you how much? 1 second. One second, please. Questions. Yes, I have this. Okay. So now 510 into 0.02. So I expect 10 employees to leave at the end of year 1. So how many will be left? Sir, I expect 500 to be there at the end of year 1. At the end of year 1. Is this actual or expected? This is estimate or expect at the end of year 2. And then a further departure of 2%. That means another 10 will go. So I will be left with 490. So I will be left with 490. 10.2. So I have taken it as 10. So this is estimated year 3 for year 1 calculations. For year 1 calculations. So can I say that this 490, I can present it as 510 into 98%. This gives you how much? This gives you how much? 510 into 0.98. This gives you 500, 499.8 actually, and a further departure of 2%. So this makes it how much? 0.98. This makes it 490. Have you understood now? Have you understood 2 times 98%? Yes. It is the same as this. Yes or no? Did you get 2 times 98% logic? Yes. Everyone, did you understand why it is taken as 98% twice? Yes. Bolo. Yes or no? All right. So now 98% twice is clear. So now what the solution has considered is nothing is wrong. I'm again repeating, nothing is wrong. It has taken number of employees 510 into 98% and each employee will get 100 shares. So multiplied by 100 shares. So we are getting 48,980. Question has given actual positions. I agreed. Lipika, question has given actual positions at the end of year 1, at the end of year 2, at the end of year 3. Agreed. But I have to account for the expenses that are going to vest over the period. Yes or no? See, if you account for the expenses based on 510 employees, if you account based on 510 employees, it means you are telling that nobody will resign in the future. My estimate is nobody will resign. All 510 will remain in service. ऐसा नहीं होता ना. It's not like that. You have to estimate 510 नहीं रहेंगे. In all respect to the employees, somebody or the other may pass away also in the 2 years. If somebody is old, has a poor health condition, you never know, he may not even survive for the next 2 years. Yes. So therefore, you cannot say that I will do the accounting only on actual number of employees. This actual number is end of the year. But you have to estimate end of 3 years how many will exercise. And that amount you will have to amortize over the current year. That amount you will have to amortize over the current year. You actually determine the expense for the 3 years and then you do the working for each year. उसी को तो हम बोलते हैं. If you look at the previous examples also, what have we done here? What is this 4,55,000? What is this 4,45,000? This is nothing but expense for the entire period of the vesting. And after that, we have allocated 1/3. That means total expense for year 1, expense for year up for years 1 and 2, cumulative, minus what we booked for year 1. And this is actual for the 3 years minus what we booked in year 1 and year 2. That is how the accounting is going to happen. That is how the accounting is going to happen. Lipika, did you follow? Yes, you are going to estimate मेरे total 3 साल का खर्चा कितना होगा, उसमें से 1/3 कितना होगा. If you do accounting based on 510, you are giving the signal that nobody will resign in the future. That cannot be the case, right? That cannot be the case. So therefore, some estimate has to go in the working. Is it okay? Yes. Did you understand? Lipika, did you follow? Others, I hope you understood. So this is how you are going to do. So now what happens is, I just gave a small note here. See, the solution had a small change. Okay. See, if you do this 510 into 98 into 98, it actually comes to 489.8 employees. It actually comes to 489.8, which we rounded off to 490 employees, which is correct. And if you multiply that by 100 shares, it comes to 49,000 options. Okay, it comes to 49,000 options. What is happening in the solution is, they have already multiplied with 100. So it comes to 48,980 options. And here it is 49,000 if you consider the employees. Here there is no rounding off. No rounding off. Whereas here there is an actual rounding off. It does not really matter in the eyes of the institute. Okay. You take it as 48,980 or you take it as 49,000. You can just give this note and finish it off. Okay. You can give this small note and finish it off. It's going to be one and the same. So 48,980 is the total options that will vest. The total estimated options. This is an estimate now. Okay, this is an estimate. Have you understood now, everyone? Did you understand the working that is there in this question? Yes. Did you understand? Is 48,980 clear, everyone? Yep. 48,980, is it clear? Yes. All right. Good. Nidhi confirmed. Uma has confirmed and others have confirmed earlier. So this we will multiply by what? We will multiply by the fair value on the grant date. Sir, why fair value? Sir, this is an employee benefit. that we are receiving, we cannot fair value that. We cannot say when the employee provides service, because he will continuously provide service. So the standard says measurement period is the grant date, and the fair value of the option on the grant date will be taken for measurement. So we multiply it by 30. So 1469,400. What is this? This is estimated expense for 3 years. This is estimated expense for 3 years. Okay, this is estimated expense for 3 years. Out of this, we will be recording only 1 year's expense because we are doing the accounting for 1 year. So the cost of options comes to 4,89,800. Comes to 4,89,800. And what have you recognized previously? Nothing. This was the first year. So 4,89,800 will be the expense for the current year. If you take it as 490 employees, वो थोड़ा सा change होगा, but it is fine. At the end, it all comes down to same number. There is no question of overall expense for 3 years will remain the same. Okay, so at the end of the third year, so you don't have to worry. Okay, all right. So now I give you 1 minute. Quickly look at the position at the end of year 2. Look at this position at the end of year 2. Do not look at the answer. Tell me what will be the expense that you will record. I think I have hidden the answer. Yes. So now you quickly tell me, you know the working. Tell me what will be the expense that you will record at the end of year 2. What is the expense you will record at the end of year 2? Just calculate and let me know. सोच समझ कर करना, गड़बड़ मत करो. 2 मिनट ले लो, चलेगा. Yes, I need your calculations. I need your answers. Okay. Or even if you give me cumulative expense for the first year, for the second year, that is also fine. End of year 1, the expense was 4,89,800. Okay, fine. Uma, be careful in your working. I see something is slightly wrong in that. Okay? Slightly wrong, not majorly wrong. Good. I'm glad you rectified. Okay? All right. I got Lipika's answer. Others, please give me the answers, because I need to know whether you have done it right or not. I need to know whether you are able to calculate it or not. Lipika, check your workings. You have also done the same mistake. Others, please check. Sriram, something is wrong. Janvi is right. Very good. What about the others? Tushar, I'm waiting. Mukesh gave his answer, which is correct. Vivek, आपका आंसर चाहिए. निधि, आशा, Tushar, Shriram. Yes. Namrata, Namrata, something is wrong. Nidhi gave the right answer. Good. Very good. Nidhi Deshpande. That's right. Vignesh, that's right. 9,70,000. That's right. Okay, fine. Let us do. Many of you got it right. Some of you did not get it right. Let us see the concept. Okay. Let us see the concept. Okay. See. First we will understand, then we will look at the question. End of year 2. See, I started the year with how many employees, sir? We started the year with 510 employees. We started, Lipika, that's right. That's absolutely right. Okay. We started the year with 510 employees. Okay. Out of that, how many left? How many left? Sir, number of employees left is 10. That is, 10 employees have actually left. So 500 minus 10, that gives you 510 minus 10, that gives you 500 employees. So tell me, is this actual or is this estimated? No, sir. This is actual. This is the actual picture at the end of year 2. Can I take this and do the accounting? Answer is no. You have to estimate now. You would have gotten further information about how much would be the attrition rate because एक और साल बीत गया तो estimate revise करने का time आ गया. So now you estimate that in year 3 there will be a 3% attrition. You finished year 2. In year 3 there is a 3% attrition. So therefore number of employees expected to remain is equal to 500 into 97%. 3% will go, no? Look at the question. Departure is 3%. So 97% will remain. So 500 into 97%, that gives you how much? 500 into 97%. That gives you 485 employees. This is expectation. Don't do another 97%. Your vesting period is 3 years only. एक साल तो बीत गया, you have accounted. Second year actual is there which you are accounting now. In the future only 1 year is left. So don't take it double. Don't take it as 97 into 97. वो गड़बड़ हो जाएगा. Your vesting period is only for the next 1 year remaining now. As of now, 2 years have already elapsed. So you expect that 485 employees continue to remain in service. Okay. So now 485 into 100 options into rupees 30 per option. So now that comes to 485 into 100 into 30. So that comes to 14 lakhs 55,000. Sir, this is expense up till the end of the vesting period. That means this is for 3 years. I will multiply it for 2 by 3 because मुझे end of second year कितना है वो चाहिए. So into 2 divided by 3. So this is 9,70,000. And from here, I will be deducting what was already booked, which is 4,89,800. So that gives you 4,80,200 as expense for the second year. Okay, so many gave the right answer. Many of you gave the right answer. Very nice. Okay, so those of you who did not give the right answer, please let me know whether you have understood. Okay, please let me know whether you understood where the things went wrong. Okay, Lipika in particular, yes. First, what you gave, you rectified it later, which is good. Uma gave the right one. Viraj, I hope you understood. Tushar Garg, aap ho, to I hope you understood. Asha, hope you understood. Nidhi got it right. Janvi got it right. Yes, I know many of you got it right. Okay, all right, fine. Shriram, I hope you understood. Yes. Namrata confirmed. Okay, good, good, good. Shriram, hope you got it right. Okay, all right. So now if you look at the answer, you will be in a position to appreciate. 500 actual, 3% estimate. So 48,500, 14,55,000, 2 by 3. 9,70,000 minus what is recognized earlier. So 4,80,200. This is my expense for the second year. This is my expense for the second year. Now you move to third year. Third year is the last day of the vesting period. So iske aage there won't be any estimates. So position at the end of year 3, number of employees who have left is 8. So number of employees entitled to exercise the option is 492. Even if they did not give this, it would be 492. See, are you able to understand? Even if they had not given 492, I was in a position to say that number of employees entitled to exercise would be 492. So this 500 comes as opening minus 8. So that is 492. I will not look at any forfeiture now. It's not because it is not available. It is not required only. Okay. Because vesting period khatam ho gaya, end of the third year. I now have the actual employees who are there. It started with 525 employees, but at the end over the 3-year period, how many employees are there? 492. So options will vest only in these 492 employees. So 492 into 100 into 30 gives you 14,76,000. This is the total expense that should be booked for the 3-year period. Out of that, you have already recognized 9,70,000. So current year, 5,06,000 will be recognized. Have you understood? Yes. Have you guys understood? Third year is clear, everyone? Yes. I hope the third year is clear. Okay, great. So now coming to our ledger accounts. What they have said at the end of year 4, 480 employees exercise the option. That means they will pay the money and get the shares. 12 employees do not exercise. That means 12 employees ka jo, excuse me, 12 employees jo hai, unka options are getting lapsed. So this is getting lapsed. And this is exercised. Okay. So this is exercised. Okay. So now coming to the next one, employees. So now the journal entries, basically this is ledger accounts, doesn't matter. It's one and the same. So employee compensation expense to SBP reserve account, 4,89,800, this figure. And that is going to the P&L. So the same thing continues for the next 2 years also. So I hope that this part is clear. SBP reserve. Now this is where the things are important. SBP reserve is getting a credit by employees compensation expenses. So by employees compensation, balance carried forward. Year 2, the balance is building up. Year 3, the balance has built up to 14,76,000. So whatever is my cumulative expense, utne ka mera SBP reserve khada ho gaya. I have that much of SBP reserve in my account. Now, let us look at the amount that I'm going to receive and how do I do the accounting of that. Okay, so now please pay attention. This is important. Okay, because this we were not doing so far. So this is not there also in the new study module which is there. So this is just for our information. See, we have given the exercise price as 125. Correct? So this will be the amount for which I will receive cash. The company will receive cash from the employee. Okay. The value of service received. This is the amount which is sitting in your SBP reserve. Yes or no? Every time you are booking, you are multiplying by 30 rupees. No. So 30 rupees is sitting in your SBP reserve. So when an employee comes to exercise, he is coming with two things. He is coming with cash of 125 and service provided of 30 rupees, which is sitting in your SBP reserve. So he is coming with total consideration of 155. As against that, the face value which is given is rupees 100. So therefore, securities premium is rupees 55 per share. Securities premium is rupees 55 per share. Is it okay? Have you understood this? Have you understood this part? Did you follow? Securities premium, I hope it is right. I hope you have understood. Not right. I hope you have understood. Yes? All right. Now we move on to the next part. See, here they have given two journal entries. We can combine it into a single entry also. I will tell you how it can be combined, or actually you can only combine it. Okay. 480 employees have exercised. Na? तो वो क्या करेंगे? They will bring cash bank. Cash bank account debit. 480 into 100 into 125. Okay. 480, 100 into 125. So they will be bringing 60 lakh rupees. Okay. They will be bringing 60 lakh rupees. Additionally, now the SBP reserve, they had already brought this in the form of service. So we will record that 480 into 100 into 30. 480, 100 into 30. So 14,40,000. Correct? To equity share capital. 480 into 100. So that gives you how much? 480 into 100 into 100. So that gives you 480, 100, 100. And then you will be having two securities premium. 480 into 100 into 55. $24 lakh, 26 lakh 40,000. Yes. Did you understand the journal entry here? What is not clear, beta? See. Securities premium. See. What is the question telling? exercise price is 125. Exercise price is 125 and 30 is your fair value. 30 is your fair value, right? 30 is your fair value. So how the employee is paying for this is, he is giving 3 years service. The value of that service is 30 rupees and he is giving 125 rupees in the form of cash. So employee is bringing a total amount of 155. How is this 155 brought? 125 which is being brought as cash. This will be on exercise, okay, when he exercises, okay. Additionally, the fair value of service is given. He has worked for 3 years, no? So the fair value of that is 30 rupees per share. You only have done the workings just now. That means employee is coming with efforts and cash together worth of rupees 155. And out of 155, 100 is nominal value. So 55 will be the securities premium. Is it okay? Have you understood? So this will be the entry that will be passed. See, when the employee starts to exercise the options, SBP reserve will be utilized. No, you cannot keep SBP reserve like that only. See, SBP reserve is type of an obligation to deliver equity to your employee. So when the employee comes to ask for equity, kahan se issue karoge aap? You will issue it from SBP reserve only, no? And whatever is the cash he bringing, the employee is bringing, you will debit the cash with that amount. Yes. So therefore, SBP reserve jo balance hai, that will go down. See, it went on increasing when the vesting period was going on. But when the exercise happens, the balance in SBP reserve will start getting utilized. No, that time, that is the benefit which is given. That is the benefit which is given. Okay. So therefore, this is how you will do the accounting. Did you understand, Lipika? Securities premium you followed. Yes. Securities premium you followed. Viraj, did you understand? The journal entry, how many of you followed this journal entry? This journal entry, how many of you followed? Cash bank, employee brings 125 per share. SBP reserve, 30 rupees will be utilized because the options are getting exercised. Equity capital, you will issue shares, and securities premium, the surplus amount. Clear, clear. All right. Lipika, I am waiting for you. Okay. All right. Coming to the next part. See, look at this entry. Nothing is wrong. They have given 2 entries instead of 1 entry. So that is why I thought first let me give you the entry in writing. Then you can compare. See, they have first taken bank account to SBP reserve entirely. And then SBP reserve account debit to share capital to premium. I'm explaining that only. There is no variance. Okay, it's exactly the same. Okay, there is no variance. See, here you have SBP reserve credit of, one second. Here you have SBP reserve credit of 60. Here you have SBP reserve debit of 74 lakh 40. Isko just cancel kar do. You will be left with 14 lakh 40. So there is no variation. Look at my entry, look at that entry. Bank account debit 60 lakhs. Bank account debit 60 lakhs. SBP reserve debit 14 lakh 40. SBP reserve debit 14 lakh 40. Share capital credit 48 lakhs. Share capital credit 48 lakhs. Securities premium 26 lakh 40, securities premium 26 lakh 40. So there is no difference. What they have done is they have basically taken the entire receipt first to SBP reserve, and then they have taken entire 155 per share from SBP reserve and divided it between securities premium and equity capital. End result is my journal entry combines both of them. It combines both of them. Okay. So there is no difference. You can follow whichever method you want to. These are just alternative treatments. Okay. All clear? Yes. So this is the working, and then we move on to the next one. See, 12 employees, options have lapsed. If the options lapse, you cannot keep balance in SBP reserve. आप नहीं रख सकते उसको. You will have to write it off entirely. So write off मतलब कहाँ? Can I take it to the profit and loss account? Answer is no. Why not? Because this is a transaction with owners. The employees are now your owners. So therefore, you cannot have a transaction with owners and the amount hitting the P&L. Dividends does not hit the P&L. It now goes directly into retained earnings. Earlier, it used to go into something known as a P&L appropriation account. So that is how you treat transactions with owners. And that is why SBP reserve account balance which is left, that is 12 employees into 100 shares into 30 per share. This 36,000, we will transfer it straight away to retained earnings. If you remember in your intermediate, the balance in stock options outstanding, you used to transfer it to general reserve at the end of the life of the options. Instead of general reserve, we are transferring it to retained earnings. We are transferring it to retained earnings. Okay, so this is how you will close. Look at the impact in the ledgers. By balance brought down 14 lakh 76. This is the 60 lakhs which you receive. This is the amount transferred to capital and premium and retained earnings. Ultimately, the balance in SBP reserve becomes zero at the end of the options, at the end of the life of the options, which has to be so, which has to be so. I cannot have SBP reserve with no options existing to be issued. Okay. With no options existing to be issued. So this is the last entry of 36,000 is the proof that options have lapsed, is a proof that the options have lapsed. Okay. All right. Sir, one doubt. In the first entry itself, they could have segregated share-based payment and securities premium. Why the amount received is credited to SBP reserve and in second entry? Yes. In first entry itself, we can make bank account debit. No, that can also be made. Yes, Sriram, you are right. See, then you play around with the entries the way you want. Okay, it's basically what should happen is your entry should reflect three things or four things. Cash of 125, SBP reserve debit of 30. You can show it in any manner you want. Equity capital of 100. Securities premium of 55. You show it as entire 125 gone to SBP reserve as a credit. Then you do 155 debit and then you apportion between 155, you get full marks. You do it the way I explained to you, 125 cash debit, SBP reserve 30 debit, equity capital 100 credit, 55 sec premium credit. That is also fine. You can do it the way you are also telling, wherein you take the entire cash received, you allocate it between the premium and the equity, and then you allocate SBP reserve to securities premium. That is also fine. Ultimately, your journal entry should reflect the picture which is there here. Anything and all alternative answers are acceptable provided you come to the final destination. Okay. So therefore, वो बोलते हैं ना, सारे all roads lead to one. तो वो that should be the principle. Okay. Everyone understood this question. So this is an important one in the sense that it gives the entries over the entire life of the options, starting from the grant date right up till the exercise period. So in that sense, this is important. Okay. So I request you to please go through this. Now what I want you to do is, I want you to go through this question for homework. The content will be uploaded. It will come today. Don't worry. Okay. So you have time to go through this content as homework. Okay. It is a very important one. It is a very important one. Why it is important is because this is graded vesting. Graded vesting. Okay. This has come in November 22 RTP, and I expect that it can be an exam question spreading for anything between 12 to 16 marks. But why it is important is because this is an option. This is an option plan where shares are vesting over a period phase wise. So you have a 3-year plan. Employees will tell 3 साल हमको मेहनत करना पड़ेगा, कुछ और दे दो. So the company will say, out of the total shares, 20% will vest at the end of year 1, 40% will merge at the end of year 2, 40% will merge at the end of year 3. So एक plan में you are having 3 different plans. So that is why this particular question is very important. It is as if one question, but you are doing 6 questions altogether if you do this one question. Okay. So I want you to look at this question very carefully. Okay. Oh yes, you can merge all the entries together to give one entry. No problem. No problem. So if I have to tell that, then what would happen is you can take this as 14,76,000. You can put this as 14,76,000, and here you will have to retained earnings 36,000. Everything in one. This is also correct. No problem. Absolutely no problem. Okay. So I want you to go through this question, graded vesting. It's very important, very interesting. So I want you to do it by yourselves. Content will come. Don't worry. Okay. Then what we will do is the next set of questions we will pick up in the next class. Okay. We have a lot of things. We have lot of things to do. Okay. We have quite a number of concepts to cover. I have to do stock appreciation rights. I have to do cancellation of options. I have to do modification of options. And I also have to do group share based payments. Okay. So we have lot of problems only to do on Monday. So please revise this and come. I don't want you to sit like as if sir ने क्या पढ़ाया था Friday को मेरे को याद नहीं. ऐसे मत करो. Okay. बहुत नाइंसाफी हो जाएगा हमारे साथ. ठीक है. तो please do this and we will meet on Monday. Revise this. Revise 113 and I think you should be comfortable. Oh yes, you will get full marks. Definitely you will get full marks. No doubt about it. Okay. You give a single entry also, you will get full marks. No problem. Okay. All right. Fine. Any doubts? Anyone? Mukesh, Lipika, you are still left with any doubts? Nidhi, Asha, or Kon? Vivek. Vivek is not there. Janvi, or who else? Kayuri, Panu, are you guys there? Did you understand? Any doubts? Any difficulties? Any Vidit, where are you? Yes, all clear. Okay. I think everything is clear. Yes. So see you guys on Monday. Revise and come. Revise and come. Okay. Revise and come, and then we will proceed. Okay. Monday we will do some small concepts and then the problems for the remaining. Okay. Thank you everyone. See you guys on Monday. Yes, this session was very good. Even I am very happy today. Yes. All right. Fine. Thank you. See you everyone. Thank you.